please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Bank merger, that's the merger of Bank of Baroda, Vijaya Bank and Dena Bank, remains top of mind this morning. Anil Agarwal, head of Asian Financial Research of Morgan Stanley, joins us on the phone line. Anil, good morning. Thank you very much for joining us. Actually, you've been pretty kind and said that it's an incremental positive for the sector. But what's your view on what's your advice to BoB investors itself?
Thanks for inviting me for this, Lata. So yes, as you know, we can't comment on individual stocks. Okay. But generally what the consolidation does is it reduces the number of banks, so it makes it easier to manage for the government. And also, if you look at the size of the bank which is being merged, it's relatively small. So if you do the pro forma analysis, just pro forma, and actual execution is much tougher. It's always much tougher. On a pro forma basis, this doesn't look so bad.
Don't you believe, Anil, that there could be increased provisioning that the merged entity will have to make? Of course, you know, perhaps higher NPL pressures in the very near term, and then integration issues, etc.
No, I completely agree with you, Sonia, on that. That execution issues are there. We need to wait and see how provisioning will pan out. It's not that we are fans of state-owned banks. We generally don't like most of the state-owned banks. There's only one state-owned bank we have an overweight on. But what I was trying to say was that it could have been worse in the sense that the bank which is being merged is relatively smaller. If you look at just the pro forma, without taking into account the actual impact when the merger actually goes through, it is not that bad.
Okay. Okay. Well, what's your view generally on corporate lenders? I mean, you did say you have one state-owned bank as a buy. I mean, it's sort of difficult to guess that must be SBI. Generally, are you still positive on all corporate lenders?
Yeah, so Lata, we have been negative generally for our stance for the last few years, 4 or 5 years, was just by the retail lenders, whether it's a bank or an NBFC, because there was a lot of ground being left for these banks to basically gain market share on. So the loan growth that private retail lenders and NBFCs are reporting was quite strong, and that is why we are positive on those stocks. We remain selectively positive on that space now. What we have been saying for the last close to a year now is that the recapitalization move done by the government was a big thing, because what it did was that finally it allowed the state-owned banks to be able to recognize NPLs, because earlier they didn't have the underlying profitability. The pre-provision profitability was very low. They didn't have the capital, so it was even if they had recognized an NPL, they didn't have the means to make provisions on those loans. Once capital came in, they have the ability to make provisions, and after that, the central bank also moved in, made recognition norms much more stringent. So what you saw in December and March quarters was very aggressive recognition of bad loans. Since then, if you look at net NPL formation, which is formation minus recoveries, actually in June quarter it was a negative number. We don't know whether it will be a negative number going ahead, but incrementally the flow of bad loans in the space is going to reduce. So what we are saying is we like corporate lenders, but we'll be very, very selective in owning corporate lenders. We would only own those corporate lenders which are well capitalized or have access to capital, because that's a big deal here. Because once you kind of take care of provision, after that, unless you have a strong ROE, how do you grow? And there are only 2 or 3 names which I think fit that bill. So we are saying buy corporate lenders, but only the largest, the 3 largest corporate lenders. Otherwise, we generally, I think, would have underweight on most of the other names.
On this merger issue, Anil, sure. On this merger issue, you know, the view is that SBI has done its bit with the merger of its subsidiaries. But do you think that there is a high probability of SBI also being included in the second round if there are more mergers?
Seriously, we don't have any view on that.
Okay.
Let's wait and see what kind of permutation and combinations work out. So it will be foolish on my part to speculate.
Okay. Well, the more important question I wanted to ask you is, Anil, NBFCs, is that also your responsibility to track them? And if yes, then what's the scene now with cost of capital shooting up, almost 200 basis points higher than same time last year?
Yeah, so what our view is that, so again, as I said, historically we used to say just buy everything which is a retail lending, whether it's NBFC or bank. We are actually now saying that again, on NBFCs also be very selective, because clearly funding cost is moving up. So last 4-5 years, they had the loan growth and interest rates were going down, so it was as good as it gets. Now funding cost is going up quite meaningfully, as you said. I mean, if I look at AAA rated one-year paper, it's gone up quite meaningfully in the last year or so. At the same time, if you look at SBI's MCLR, because that's basically an indication of lending rates on higher grade corporate or mortgages, that's gone up by only about 50 basis points in the last 1 year. So clearly underlying margins are under pressure. So in this backdrop, we would be averse to owning NBFCs. There may be a couple of them within NBFC space which are fine, but generally our view is that in India the big theme is asset quality cycle is normalizing, so that's great for some of the lenders, which should cause normalization in ROEs. And second is liquidity is tight. So in the last 5 years, banks who are sitting on high CASA balances or high good quality deposits were basically, there was no upside of having liquid balance sheets because interest rates are low. But as rates go up, that liquid balance sheet becomes very, very useful, very profitable. So our view is just own banks either who have very strong liability franchises or you own these asset quality turnaround which have access to capital.
Mm-hmm.